Today, I'm very pleased to have with us Kirsten Luthi, who's a partner with Osage University Partners. I'll let her discuss more about what they do, but actually Kirsten's been working with our office for a long time. She brings a long career in tech transfer at Stanford to what she's doing now at Osage. And Osage is also a key partner to Penn. They invest in early stage technologies and also support us in our commercialization efforts through programs like this. Thank you for joining us from sunny California.
Thanks so much, Lori. Just to talk a little bit about OUP itself before we get into the VC 101 topic. So OUP, we're a venture capital fund and that invests in startups out of universities. We do that by partnering with the universities, in particular their tech transfer organizations and new ventures organizations, to learn about the startup companies. We have a lot of programs that we work on with those universities, such as this, which are even more important during this time where we're socially distanced from each other, et cetera. We need to be able to obviously keep up that networking, keep up our educational aspects as we go through this time. We are on our third fund at OUP. We've closed on over 100 investments between all of our different spinouts that we've looked at from different universities. And we have actually an 18 member team now. Mostly in just outside of Philadelphia in Ballackinwood. But I do represent our West Coast, office, which is of course my home. It's always my home, but particularly now it's my home. So, all right, let's jump into venture capital itself. When you're talking with venture capital, it's really important to understand actually how venture capital works and why venture capitalists are doing what they're doing. So understand that when you're going to talk with them. So I'm giving a little bit of information about how VC funds are organized and how they run in order for you to understand that when you're going to talk with them about why they're interested in what they're interested in, okay? So venture capital organizations, when people talk about venture capitalists, they're usually talking about the general partners of the fund. They're the ones who go out and raise the money for the fund, and they raise that from limited partners, and we'll talk about those in just a bit. They manage the funds, and they're the ones who make the investment decisions. There's usually an investment committee at a fund that's making those investment decisions about which companies they're going to invest in. The general partners are assisted by principals and VPs and associates and other analysts who are helping kind of do the heavy lifting of actually looking at the opportunities that they have to invest in themselves, okay? The venture capital fund is the money that is raised from these limited partners that's based usually on some sort of unique strategy or expertise, et cetera, and their track record that they have on actually performing in investing. So I mentioned earlier that we invest in university startups. We're looking at deep science, all sectors, deep science, technology startups. And that's what our focus is. And the reason that we think that that's a particularly interesting focus is with the track record of those university startups. And so we partner with these universities to look at those for investments, and obviously been able to find investors who say, yeah, that's a really good strategy. Universities have some really terrific intellectual property and commercialization efforts that we'd like to potentially invest in. So when you go out and raise these funds, it can take months to over a year to actually raise this fund. And we're going to talk about why that's important in a little bit, but just keep that in mind when you're going out and talking with VCs. Know where they are in their fund life cycle, okay? All right, so then there's the limited partners. These are the groups that provide capital, the money that goes into the fund. These can be insurance companies, endowments, pensions, high net worth individuals. They can be other corporate endeavors, et cetera. And usually what they're doing is looking to have a variety of investments in their portfolio. They usually have a lot of capital, right? But they're trying to have a variety of investments that maybe are going to give them a better return than, for example, just the market would give them. And so they're looking to invest potentially in these venture capital funds because they could potentially earn a lot of money from those venture capital funds. However, they're also riskier investments. And so That's something else that they take into account. They're not going to usually just solely be investing in venture funds. And the reason that they're so interested in investing in these venture funds is the amount of profit potentially that they could be making on their money. So let's go into the compensation about venture funds. So first of all, there are management fees that the venture funds charge to their limited partners. They usually get 2 to 2.5% per year for that of the total amount that they raise. So for example, on a $100 million fund, they're going to be receiving $2 to $2.5 million a year from the limited partners to actually operate that fund. Okay, so that's going to be their rent, their salaries, travel, computers, whatever else they need to actually operate the fund. They live on that 2 to 2.5%. But obviously what the LPs, the limited partners and the general partners are going for is this eventual profit that they may have. So as they invest in companies and those companies exit, hopefully they'll be making a profit on those companies. So first, those profits go back to repay the limited partners, okay? So they're repaying all of that capital to the limited partners that they've already received from them. I should back up for one moment. When I say that the limited partners are investing in a fund, they're not actually investing that all up front. They're not saying, hey, I'm going to commit $20 million to you. Here's $20 million. How it works actually is that the venture capital firm calls the money when they need it. So they say, hey, we're projecting out for this next quarter, we're going to need about 5 to 10 million. Everyone, you need to contribute X% of what you committed to the fund. So one of the things the general partners are doing when they're going out and getting those limited partners is making sure, is this someone who actually is going to be able to stay in the fund and honor their commitments to the fund throughout the entire life of that fund. So they're going out and calling this money from the limited partners. And then as they receive exits from the companies they've invested in, they're going back and repaying what the limited partners have already put in the fund. Once they have basically repaid 100% of the committed capital, plus some sort of interest, the limited partners get some sort of interest for providing this capital in the first place. The profits are split usually 80-20. So 80% of the profits, so a good chunk of those profits go to those limited partners. That's why they're doing this, right? As they're thinking potentially we could have a great return if this fund performs well. And then 20% of it goes to the general partners. That's again, those are venture capitalists, and that's called carried interest. And so whenever you hear about the carry, that's what they're talking about, is that 20% of the profits that goes to those general partners. Okay, so that's what when you're talking with VCs, they're interested, first of all, in making that profit for their investors. So their investors will want to invest in a subsequent fund that they have. And we're going to talk about that in just a minute. But they're also they want to have that 20% of the profits that they're potentially going to participate in as well. Okay. All right. So this is how funds typically work, is that funds, and this is not always the case, but they often have 10-year lives that they're able to extend for 2, maybe up to 4 years. That's pretty rare, but it does happen. And after that, they're potentially liquidated. The initial investment period, so investing in new companies, is usually going to be made in the 1st through 4th year. So typically they're going to be making these investments in new companies during year 1 through 4. So this is the total of the 10, 1 through 4. And then they're going to do follow-on rounds in those same companies, probably throughout the rest of that, perhaps that life cycle, until there's some sort of exit event for that company. All right. But once you've gotten to year 4 or so, you're out of money for new companies, right? So you're typically then going to be going out and raising your next fund. And you're going to be raising that on the track record of your previous funds. If you're only in your first fund, you're raising it on the track record perhaps that you have so far, plus perhaps other experience that you've had in that. So while the fund is kind of wrapping up that initial investment period, they're going out to raise the next fund. So let's say we're right here, they're raising the next fund, and then they're going to have another fund going there. And then they're going to do the same thing again. So they could have multiple funds going all at once. So for example, we're in OUP3, we're in our 3rd fund, which means our 3rd fund. We've got 3 funds still going because our first fund has not fully exited yet. out of all the companies that we invested in back with that first fund. And in fact, for example, for the Fund 1 and Fund 2, we're still making follow-on investments. We're making additional investments in the companies that we had already invested in during those original funds. So when you're talking with VCs, it's important to know where they're at in their fund life cycle. Are they in those first 1 to 2, 3 years, or are they in the 4th year of that fund? Are they raising a new fund? How long do they have until they need to see exits? So if they're in the 4th year of that fund and they haven't raised the next fund yet, they need to see an exit hopefully within 6 years. And that's something you have to be thinking about as a company is, can I actually make, can I say, yes, we expect an exit within that time period? If not, it may not be a right match for that particular fund. So know where a fund is at in its life cycle when you're going to talk with them. Funds typically reserve $2 to $3 for every dollar they invest. So if they're making a $2 million investment, they're going to reserve $4 to $6 million for follow rounds. Now, this depends on where that company is actually at in its fundraising life and how close it is to an exit event. So let's say it's a later stage asset that they expect to file to go public in the next 2 years. You're not potentially not going to reserve that much for that particular company, right? But if it's an earlier company like seed, Series A round, where they don't maybe have that expectation at that event, the fund should be reserving that. And so one of the things you need to know when you're talking with a venture capital group is, do they have that capital to potentially to invest in future rounds of your company? Because usually you're not going to raise one round and be done. Particularly in the life sciences, you're usually going to be raising multiple rounds because you're going to reach certain, diligence or certain milestones in your development, and you're going to need additional money then saying, hey, we hit this diligence point, this development point. Now we're going to need additional capital to get to our next one, and we're going to raise money based on our actually hitting this development milestone. So capital formation. So let's talk about funding sources themselves for scientific, this is particularly for scientific endeavors. But when you're working in an academic institution, you have to be thinking all the time, okay, how am I going to get this funded? And this very well, being from academic centers. So you're, often dealing with the grants themselves, right? And I imagine that most of you are aware of SBIR and STTR grants and other types of grants that can actually help you get to the next phase of proof of concept of your particular endeavor that may be beyond kind of the basic research that you've typically been doing at the institution. Then there's other types of rounds going from there. There's a friends and family potentially you could be going out. Then there's also potentially venture philanthropy that you could be going after. There are a lot, obviously, foundations out there who want to help support scientific work in their particular area that they're passionate about. There are a lot of angels and accelerators out there, incubators that want to potentially provide those pre-seed and seed rounds for the companies. And crowdfunding is a newer thing. I would say that we haven't seen a ton of it, but it is something that, at least in the academic space, but is something that has worked for some people. And then of course there's venture capital, and so that's what we're mostly talking about today. But beyond that is strategic investors. So I do just want to touch on that really quickly. And this is where you get companies involved, and companies a lot of times have their own venture capital arms, and talking about how they want to strategically invest in companies, either with the eye of this being a potential company that they like to acquire as an asset, or it's just a space that really interests them and they'd like to support that particular space, and they think that it could be advantageous for them economically. I think all of you probably know this, but I'm just going to reiterate it. And the majority of startups don't necessarily require venture capital funding. Venture capital funding is very costly to the startup, and we'll talk about why that is in a little bit. But it is something that, especially if you need quite a bit of capital, it very well may be the way to go. But VCs look at a lot of investments, and it's very few of those that actually make it to the closing. So this is just something that comes from an article called "How Do Venture Capitalists Make Decisions?" But basically, this just shows you how many projects are even considered and then make it through meeting the management, reviewing it with the partners at the venture capital fund. We actually do due diligence, offered a term sheet and closed. And so it just, there's this winnowing process that becomes very narrow for those deals that actually make it to the point of actually, getting a term sheet and getting that signed and getting the investment from venture capital. But a lot of it has to do with, dating the right people, finding the right fund for your particular endeavor. So we've just given you some, and I have this as a life science slide here just to show you the types of investors there are. But investors, you need to get to know your investors. You need to understand who really is going to be looking at your particular space. What investment areas are they looking at? Are they looking at things in certain indications? Are they looking at things at what stage the asset is at, et cetera? Just that my main message here is you need to get to know the investors, and you need to get to know the particular investors at the area who may be particularly interested in your what it is that you're trying to do. So, one of the things you're going to do, obviously, at some point is a competitive analysis, and you're going to find out, okay, what are the companies that are actually working in something similar? Who's invested in those particular companies? Who were the investors at those investment firms who invested in those companies? And sometimes it's just calling them up and asking them for some advice. Understand, you invested in XYZ therapeutics. We're working on something in a similar space. Here's some things that we're thinking about next. Any reactions to that? Just start a conversation to see where that might go. You're going to have a lot of questions along the way. Know what those questions are, and then go out and find some experts. So this is just giving a tech example. I think that most of the people on this call are life sciences. I could be wrong, but same type of thing. You're going to want to get to know your investors. We've given you some ideas of investors to look at for certain types of things, et cetera here. But and the other thing that investors can do is they can tell you about other investors who may be interested in those particular areas. So, that's another thing that you can ask investors about. I think that one of the challenges right now is networking and getting to know people, but I think people have been figuring out creative ways to do that in this environment as well, with virtual meetings and happy hours, et cetera. We did kind of an analysis of what we see across different university startups as far as initial founders equity allocation. And I will say this is not to say this is how it works all the time at all, but just to give you an idea, this is often how it, we see structures similar to this. The lead founders and CEO typically get the largest chunk of ownership, right? And then the co-founders and employees, there's another pool that's for them. And then there's always going to be an option pool that you need to have. You need to have an option pool as you start hiring people to incentivize people to come work for you, because typically the salaries at startup companies are not as high as they are at the larger companies. So the options and the potential to have stock in the startup is something that incentivizes people over time to remain with the company. And options, we can talk we have other talks that are on options, et cetera, but it's something that you need to have for your employees. This is another kind of chart of potential ranges of pre-financing, and actually some of this is actually after financing, equity percentages. But the ones I want to point out to you, because we get the most questions about, are about the CEOs and the scientists. So the founding CEO usually is getting a large chunk of the initial equity. We say 30 to 60% here. It can vary even more than that, depending on who it is and what they're bringing to the table, et cetera. And eventually, though, that founding CEO, that is going to vest over time, by the way. They don't necessarily just say, here is your chunk right up front. But you may eventually bring in a professional CEO. And at that time, you're going to allocate them another chunk of stock. And that's going to be a lower chunk, but it's going to be worth more, right? Because you've already brought along the company certain ways. And we're going to go into the dilution a little bit about how that works in the next slide. Active founding scientists, which is basically a CTO or a chief scientist, et cetera. It may be part-time, but most of these are people who end up leaving the university and going with the company itself. They're going to be very involved with the company going forward. We have a note here that active founding scientists are more typical in tech companies than they are in life sciences. And I think the exception, of course, is the grad students potentially who leave and go with the company themselves. But then there's the passive founding scientists. So these are typically advisors, scientific advisory board to the chief scientists. They're not usually spending like a large chunk of their time at the startup company. So they're not going to receive very much, but they have, they want to be recognized for their involvement and actually, you need to have often those scientists involved with the company because they're the ones who know the technology. If you don't have them involved, you need to, you're going to have a hard time potentially taking that technology forward. So, and then there's other ranges in here, et cetera. A lot of this is based on, you can see engineers is based on the tech field. But just FYI, you need to be thinking about your equity and your equity allocation. And this is something that you'll get into as you bring on investors, as you bring on attorneys, et cetera, about how this will work. We always like to talk about dilution and how that works for the company. I'm not going to run through the full scenario here, but basically, as you bring investors in, the original pool of people who received equity is going to get diluted down. So let's just run through the first example on here, which is the seed example. Okay, so in this case, we said the option pool was 20%. And actually, so this was obviously greater before this particular round. The co-founders and founder and employees was 30%, and the lead founder and CEO was 30%. There was an investor who came in and invested $1 million on a $4 million pre-money valuation. So the pre-money valuation is, here's how much we think the company is worth right now. Okay, so it was a $4 million pre-money valuation. They invested $1 million, that's a total of $5 million. Now that's the post-money valuation is the 1 plus the 4. And so because that $1 million out of the total of $5 million is 20%, that's what the investors received is 20% of the company for that round. And so everyone was diluted down 20% from their original round, okay? And so you can go along with that same math all the way down to this final round, this Series C dilution, which was another 20% dilution. And basically another investment was made. It was a $20 million investment. So I'm all the way on the right-hand of the part of the chart now, $20 million investment on an $80 million pre. So they had created enough value in their company now that they were saying, we have an $80 million pre-money valuation. Our investors are coming in and investing $20 million. So our post-money valuation is $100 million. So that $20 million that was invested was basically buying 20% of the company. So everyone else was diluted down then again, 20% for that series. We're talking about the Series C. I didn't go through the examples in between, but that's basically how the math along the way works, right? You've got your pre-money valuation of how much the company is worth prior to the investment. The investment itself is added to the pre-money valuation number, and that comes up with your post valuation for the company, okay?
Is this scenario that you just talked about from published data or from the OUA portfolio?
Yeah, so this, I mean, so this particular scenario that we created up here is something that we came up with, but it is something that I don't think is far out of the realm for any startup. And then the scenario at the bottom that says the average successful startup raises $41 million in 4 rounds of financing at around exiting around $240 million value. With the lead founders having around 12% ownership at that point. That is based on some tech data that our team pulled. So that is actually from data that they pulled.
Is it better for the founder to increase the employee option pool pre or post financing? That's a great question.
That's a great question, and it's usually part of the discussion with the investors, and figuring that out with the investors. And so I think that we've probably already made the point that dilution is a necessary compromise of getting to a large exit. If you need a lot of capital in order to get to the point that you're going to be able to exit out of your company, you're going to have to be diluted down. So the other thing that we don't have this in this particular scenario, but as you have an exit event, investors typically have preferred shares and they're going to get paid out first. So let's say you have raised $25 million, but your exit is 20 million. Those investors are going to get paid out first. And how that actually flows down, how that waterfall works, depends on the terms of each round of those investments. And so we didn't get into specifics on that, but that is something else to note, is that investors will get paid out first. So if your exit is lower than the amount you raised, the common stock usually would not see anything. If it is greater than the amount you raised, then there's a different scenario that works. And we actually have another presentation kind of on that gets much more in depth on that, but we're always happy to talk with people about that. So
for the life sciences, is it becoming more common for investments to be made via SAFE?
So we have not been making them in safes. So the capital that is usually raised in life sciences is usually is often quite a bit larger than in tech. And so safes are typically used for pre-seed and seed rounds, so very early rounds. And usually in life sciences, you're raising so much capital that that's just not usually going to make sense. If for some reason it is a small round, it could be, but it's not something that we're seeing because we're more typical of venture capital.
What is the VC perspective on SPACs versus IPOs?
That's a huge area of discussion right now. Our companies so far have it's IPOs. So in general, I'm not going to fully answer that question. I'm going to answer that question. It's not answering the question directly, but these days in the life sciences, IPOs aren't an initial public offering is yet another funding mechanism, right? And if for some reason a SPAC seems like the right way to go, I'm not an expert on. I really don't. That's not something that we're seeing all that much. But it's obviously it's kind of becoming this the vehicle of the moment, right? But in the life sciences area, I think that one of the concerns was that the IPO window might shut, and so far it has not. I'm just going to talk briefly about pitch decks, and I'm not going to go through everything in each one of these slides because we only have 20 minutes left, but you do only have one chance to make a first impression, and you want that to be the best first impression that you can make. Even if this doesn't end up being your investor, they may have a device and links, et cetera, that may help you. And so just keep that in mind is you want to make that best first impression to who you're talking to. So you want to talk about who you are, show your enthusiasm for this, why your data is compelling, talk about your addressable market. You want to know your exits. You want to basically anticipate the questions that they may have. And you may not be able to get to the anticipation that you have of all of those questions, but you at least should have, have thought of them and have answers on deck if you can. You're not always going to have those answers though, and that's okay. And it's okay to say, I don't have that answer, but I'll get back to you on that too. So this is often what we like to see in a particular investor deck. Some of this really just depends on the area, how much you're going to put in each one of these. But we actually really like to see the leadership up front. We want to know who's involved with this and why they're involved with it and how they've worked together before. We do like to see teams that have been successful together before, even if they weren't successful. Were they successful, but maybe the science didn't work out, and that's okay. Especially in the life sciences, that's one of the main reasons that anything fails is because the science didn't translate perhaps from what they initially expected, from the basic research to the more applied. So that's really important for us on the leadership side. So we often like to see a leadership side that kind of, has their headshots, has where they've worked, and then you can kind of see across the bottom, like how they've actually interacted and things that they've done together before. On the life sciences side, our team, because our investment team is all PhDs and doctors, they get really into the data. But you can't, you're only going to cover so much of the data, in this, however long you have, because you do have to get to other things. You've got to get to your competition. You've got to get to your capital and why you're raising it and what you're going to do with it and why that's going to get you to that next development milestone. And then what you're going to need in the future as well. So because you're going out to investors who hopefully aren't going to be a one and done, they're not just going to invest in you once and be done with you. You're thinking about, okay, how are they going to invest in me in the future? And what am I going to be asking for in the future as well? So that's what we like to see in these decks. We've already talked about some of the practical suggestions for pitching about, being upfront when you don't know something, anticipating questions. You really need to be upfront about your data, show the good and the bad. Obviously you want to concentrate on the good, but also say, here's some other things that we did. This didn't work. That's why this didn't work. So we're not pursuing that strategy or something about that. You're going to get questions from people like, oh, well, other people have, tried this before. Why is what you're doing going to be different?
In the age of COVID and mostly virtual engagement, can you just talk a little bit how your firm is dealing with that? If that means you're seeing more pitches or, all that kind of stuff.
Yeah, I think like many investors, when this first started, the first couple months were like, well, I don't know, we're not going to invest until we meet people, et cetera, in person. That has totally changed. We do everything virtually now. And it's interesting actually, because Zoom or whatever medium, whatever software you're using to actually have these interactions, has actually brought up about some pluses. When you're in a boardroom with people or in a large room, you can't look at everyone in the face the entire meeting, right? Whereas, when you're in these, you can see everyone and how they're reacting and how they're paying attention. And you can also, because you're not traveling all the time, you can do a lot more one-on-ones. And so that's something else our team has discovered is you could do a lot more one-on-one conversations, get to know each of the individual team members, perhaps even more than you did so before. So it's, I have a feeling there are going to be a bunch of practices that are changed as a result of getting used to not necessarily meeting people in person all the time. And then, that also helps people because it means that you don't necessarily have to be close to your investments, right? You don't have to be in the same city. You don't have to necessarily be visiting them all the time, but you're catching up in a real-time manner in other ways, through these videos, through calls, et cetera.
Pros and cons in terms of, you don't have to get on a plane to fly cross country to make your pitch, which can be expensive and time consuming, especially if you're a startup, or most VCs are on the road constantly. So maybe this is a little bit of a respite for everyone.
Right.
But at the end of the day, you want to have a way to build trust, and that could sometimes be challenging through a screen. So,
Right. Well, and one of the things that, and I don't know if I can't remember if it's later in this talk, but we only have 15 minutes left. So let's see what we
yeah.
can do. But one of the things to know when you're talking with investors is they are going to be researching you. They are going to be talking to people they know who you may know from previous companies, who, if you already have employees, they're going to talk to employees who've left and why they've left. They're going to be digging in. That's what they do. They want to make sure that they're making, a good investment. Not only are they going to, be getting an impression of you through this medium, but they're also going to be getting insights from others as well.
Great.
All right. We already talked a little bit about targeting investors, and really important though, be prepared for rejection. VCs, we say, I think I mentioned this earlier, but we're currently tracking over 7,000 opportunities between our different academic institutions that we work with. We make 10 to 15 new investments per year. So all VCs say no a lot more than they say yes. Early stage companies are interesting. One of the things that I've noticed as a trend is there are a lot more early stage investors, and especially early stage investors focused on specific areas than there were before. And so I think that that's a really encouraging trend, particularly in the life sciences where, you need those early dollars to get more proof of concept data in. So let's talk about the due diligence that VCs do. Again, you're trying to understand the VC mindset here. So we're always evaluating the risk and the opportunity. I have to say, so when I made the switch over from tech transfer to venture capital, I was amazed at some of the risk that they were willing to make, and that often willing to make the risk based around the team. That they have a lot of conviction in the team. Okay, we're willing to take that risk. So investors in general are always just trying to, they're always saying no, 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 until they can't figure out a reason not to say no. They can't figure out a reason not to say no anymore to it. And entrepreneurs are always working on trying to get to that yes. So the things that we're trying to look at that are going to drive success and failure, as you can see from this slide, are exactly the same. The team, the business model, the technology, the market, the timing, and the luck. They're exact reasons why the business is going to either succeed or die. And so there's this really interesting article that I mentioned earlier, because there was one of the charts from it about how venture capitalists make decisions, where they asked venture capitalists, what were the factors contributing to a successful investment? And you can see here, there's all sectors on the left-hand side, life sciences on the right-hand side, and the business model and the team is the major reason that for all sectors that they considered that the investment was successful. If you go over to life sciences, though, you can see that the second largest reason that the investment was successful was the technology. Okay, so that's different than when you're looking at all sectors. So life sciences, it's a lot to do with the team, but it's also a lot to do with the technology. And it's interesting. So the same question was asked about when something fails, what factors contributed to the failed investment? Again, it's the team. And then for life sciences, again, technology is huge there. And actually here, technology actually surpasses the team, because again, in life sciences, it's just it's really difficult to translate the science from the research lab to an actual product. So that's where a lot of the failures occur in the life sciences. So when we're doing our diligence, a lot of our focus is on the team. We're really doing heavy diligence on them and saying, is this the right team for this opportunity? What do they have? What are they missing? et cetera. And then from there, on the tech side, they're really looking at market opportunity. What is the market opportunity for this particular this startup? And for the life sciences, we're looking heavily at that science and clinical data. Again, I mentioned how science heavy our team is, and that's the reason why, is they need to understand really what are the pros and cons of this science. And there's a whole bunch of other reasons that things that we're looking for in diligence that are noted down there. But when we're writing up these investment memos and talking about the diligence, those are the factors we're looking at.
What are the key documents needed during due diligence in addition to tax records and business plans?
Right. So data. There's going to be a lot of the scientific data that's going to be needed. Anything on your intellectual property that you've done so far. But we're going to be looking. So when I see how I'm showing you each of these areas, we want to know what you think on each one of these areas. So in life sciences, particularly, what is your regulatory pathway? How are you going to get reimbursement? How is that going to work? What's your capital structure? How is this, going to work over time? What are you looking for as far as not just your capital now, but in the future, and what are you going to need it for, et cetera? So I think that somewhat answers the question, but we want as much information as possible about the opportunity and how you're going to take this forward and why you're the right folks to potentially do so.
How do you check for IP in the life sciences, especially if the research is done abroad or at an institution abroad?
The patent application should still be something that the VC can review. And then the IP due diligence is usually done in 2 stages. So there's kind of this initial IP diligence. So it's looking at the patent application itself, seeing, what else is around there, et cetera. And then, once it looks like, this IP looks like it could be interesting, there's later they'll potentially bring in an attorney to do a full analysis, freedom to operate, what else is otherwise out there that could limit this, anyone who's filed before in this area, how successful they were, do the claims cover what we really need them to cover? And also, thinking about, well, what intellectual property would we potentially be looking at in the future as well? But that would be kind of a second stage diligence aspect on that. And usually the lead investor is the one who's hiring that attorney to do that. But I'm wondering actually if the question was more about the filings themselves, since it was mentioning international, but you're going to at some point have to be willing to share your intellectual property filing.
I think that's probably the best.
You're going to need to, right.
Okay.
And as you know, a lot of VCs don't want to sign CDAs. I will say that we do sign CDAs, but we have to have an interest in the company before we'll do so. So
what about how important is, or what do you think about success due to the diversity of the team or the board, or how important is that for you when you're evaluating investment?
Yeah, really more. It is very important. One of the things that we look at when we look at a team is how well they complement each other, but also how they work together and challenge each other. And I know I'm not directly answering the question, but you don't necessarily want a team that all thinks exactly the same way, because then they're going to miss things, right? That's a real problem. If they're going to, they all think, well, this is the path where you should head it, and we're just going to go this way. We do a talk on basically a scientific founder finding their kind of, business partner, et cetera. And you want someone who fills in your gaps and doesn't, have exactly the same thought process, but that you can at the same time work collaboratively with, not in an antagonistic way, where you can challenge each other, but it's a challenge that's moving you forward. And so it is something that I think is very important in having, teams that don't think the same way. And I think that that's good where it goes, to having a diversity among your team. So does that answer that question?
Yeah, I think that's
I'm trying to
a
get
good answer.
behind the thinking, and it is very important, and it is actually something that I'm very passionate about personally. So
Do life sciences startups typically take longer to exit, and how do VCs account for this? I would say yes, but let's hear.
yeah. So potentially yes, because they can take, but because the IPO market has been so open for them in the last few years, it's been interesting because of that, because it's really seen as this fundraising event. A software startup, yes. But other, engineering startups, no. Like we have investments in the quantum computing space, right? That's a really potentially, long exit time. So yes. So I would say my general impression is yes, but it really depends on the area that you're trying to compare it to.
At what phase of clinical development would a VC want to know about reimbursement strategy?
We want them to be thinking about reimbursement strategy early. Like they need to know what that possibility is, because again, even when we're investing early, we need to know that there's going to be a strategy for that. Like, who has done something similar to this before? How would that look like? Is this going to be a new path that they have to hoe themselves, or is it something that's already established? So you need to be thinking about it early. You may not have all the answers, but we need to know that you've thought through, because VCs are always looking at how they're going to exit. And if they don't see a reimbursement path perhaps for this, then that's going to be a real problem.
This has been super helpful from a founder perspective. And I'll just add, we've gotten a lot of comments about how great this presentation has been. So thank you. The question is, for current students, master's, PhDs, what would you recommend they do to best position themselves for a career in venture post-graduation?
Yeah, so I can that one I can answer pretty simply, just because our life sciences investment team, I can just talk about how they got into venture. So a number of them actually went into consulting and project management after they did their PhDs. And the reason that that's so valuable is because you really learn different aspects perhaps of how life science companies work, and you learn how to evaluate an opportunity, kind of from start to finish. So you can look at, I'm happy to send everyone the bios of the background of our investment folks, but that is a good way to potentially take those first steps towards that. In the tech area, that I'd say the most common way is to do a startup. And then, or it is a very common way, is to do a startup and then to go into venture capital. So that is certainly another very tried and true way, is to go ahead, work on some startups for a while, and then potentially to make that path. But so those are two different possible paths. Once an venture investor becomes serious about potentially looking at an investment, they start something called an investment memo. And this is something that they're keeping and they're updating all the time with their progress on looking at this particular company. So just know that when people are talking about investment memos, that's what they're talking about, is this document that they're keeping about, the pros and cons of basically making this investment. And this is often the things that we have as components of our investment memo. I'm sure there are other things that we can add to this as well, but just FYI, that's one of the things the venture capitalists are doing. So.
And thank you so much. I hope you have a really nice upcoming holiday season, no matter what it looks like, and for all your support and partnership with PCI.
Oh, yeah, absolutely. No, and thank you so much for having us.